Tax considerations. FINRA Rule 2210 has some very specific rules about if we're going to say something is tax-free or tax-deferred. Customers are easily confused. Prospective investors don't really understand. We don't want to confuse them. We want to be as explicit as possible. That's what this rule has to do with. So FINRA Rule 2210 specifies that in retail communications and correspondence, references to tax-free or tax-exempt income must indicate which income taxes apply or which do not, unless income is free from all applicable taxes, and provide an example of income from an investment company investing in municipal bonds that is free from federal income tax but subject to state or local income taxes. So this idea that if you've got a portfolio of municipal bonds, the dividend distributions are tax-free federally, but any capital gain distributions would be fully taxable at the state and federal level, and the municipal bond interest income, which flows through in the form of dividends to your client, is taxable on the investor's state return, unless the bonds are issued from the same state in which the investor lives in. So this has to be explained in retail communications and correspondences. No communication with the public can characterize income or investment returns as tax-free or exempt from income tax where the income tax liability is merely postponed or deferred, such as when taxes are payable upon redemption. For example, in a variable annuity, when you're in the pay-in period, you don't owe any taxes currently. When do you owe taxes? When you take out your earnings. And then you're going to owe taxes at ordinary income rates. So you can't advertise that as tax-free. It's in fact tax-deferred. Same thing with the cost basis in a qualified plan is zero. When you take the money out, it's not tax-free. It's taxable at ordinary income rates. Comparative illustrations of the mathematical principles of tax-deferred versus taxable compounding are allowed when very specific rules are followed. So these comparative illustrations must depict both the taxable investment and the tax-deferred investment using identical investment amounts and identical assumed gross investment rates of return, which may not exceed 10% per annum, so per year, 10%. Must use and identify actual federal income tax brackets. So you could use a 25% income tax bracket. You can't use a 13% income tax bracket. There is not one currently. Are permitted but are not required to reflect an actual state income tax rate, provided that the communication prominently discloses that the illustration is applicable only to investors that reside in the identified state. So if it uses a state income tax rate, it must say what state's rate and caution readers that it's only applicable in that state. If it is intended for a target audience, must reasonably reflect the target audience's tax bracket or brackets, as well as the tax character of capital gains and ordinary income. Must reflect the impact of taxes during any specific investment payout period identified in the illustration, may not assume an unreasonable period of tax deferral, must include the following disclosures if they are applicable: the degree of risk in the investment's assumed rate of return, including a statement that the assumed rate of return is not guaranteed. So this is a hypothetical illustration comparing the tax deferred versus a taxable investment. There is no guarantee of the rate of return in the future. The possible effects of investment losses on the relative advantage of the taxable versus tax-deferred investments. The extent to which tax rates on capital gains and dividends would affect the taxable investment's return. The fact that ordinary income rates will apply to withdrawals from a tax-deferred investment. Underlying assumptions must be disclosed, things like the age at which an investor may begin withdrawing funds from a tax-deferred account, the actual federal tax rates applied in the hypothetical taxable illustration, any state income tax rates applied in the illustration, and the charges associated with the hypothetical investment. The potential impact resulting from federal or state tax penalties for early withdrawals or use on non-qualified expenses. So if you take money out of your variable annuity under age 59 and a half, if it doesn't have a special exception rule, there is a 10% early withdrawal penalty. If you take money out of a 529 plan and you use the money not for qualified higher educational expenses, there is also a 10% penalty there as well. That an investor should consider his or her current and anticipated investment horizon and income tax bracket when making an investment decision, as the illustration may not reflect these factors. These rules for comparative illustrations apply to any illustration of tax-deferred versus taxable compounding, regardless of whether the illustrations are found in a communication promoting variable insurance products or a communication discussing the benefits of investing in an IRA or a qualified plan like a 401k plan. There are also standards that are specifically applicable to communications concerning variable insurance products. So very specific rules. They're found under NASD Rule 2210. Communications with the public about variable life insurance and variable annuities. We want to make sure that the client always understands what is being discussed. So in order to make sure that that is the case, all communications must clearly describe the product as either a variable life insurance policy or a variable annuity, whichever one is true. Member firms may use proprietary names in addition to this description. In cases where the proprietary name includes a description of the type of security being offered, there's no requirement to list a generalized description. For example, if the material includes a name such as the XYZ variable life insurance policy, you do not need to include a statement indicating that it's a variable life insurance policy because it says so in your firm's title of the product. Considering the significant differences between mutual funds and variable products, the presentation must not represent or imply that the product being offered or its underlying account is a mutual fund. Similar to one, but you can't advertise it that it's like a mutual fund. So there's certain benefits of the variable annuity. Of course, variable life insurance has protection, which is a big deal, versus just putting money into a mutual fund. Liquidity, something to highlight in any communications. Because variable life insurance and variable annuities frequently involve substantial charges and or tax penalties for early withdrawals, there must be no representation or implication that these are short-term liquid investments. They are not. So it's highly probable that these variable products, either an annuity product, any annuity product, and a life insurance product, in the beginning years, there's substantial surrender charges built into these contracts to encourage long-term holdings. They are not liquid. Presentations regarding liquidity or ease of access to investment values must be balanced by clear language describing the negative impact of early redemptions. Examples of this negative impact may be the payment of contingent deferred sales loads and tax penalties, and the fact that the investor may receive less than the original invested amount. With respect to variable life insurance, discussion of loans and withdrawals must explain their impact on cash values and death benefits. So a concept recently one of my students had on their test was this idea of, if you have a variable life insurance policy, can it have early surrender charges that would affect your cash value, how much you could get? Absolutely. But do they affect your death benefit? Never. Variable life insurance is protection. So there's no early surrender death charge. No. It only has to do with taking out cash surrender. And if you take out a loan against your cash value, then there's less protection when you do die. And of course, they charge you interest on your loan. Claims about guarantees. Insurance companies issuing variable life insurance and variable annuities must provide a number of specific guarantees. For example, An insurance company may guarantee a minimum death benefit for variable life, that's the policy's face amount, or the company may guarantee a schedule of payments to a variable annuity owner. So this is like the least it could be. They can promise you that. Variable life insurance policies and variable annuities may also offer a fixed investment account, which is guaranteed by the insurance company. The relative safety resulting from such guarantee must not be overemphasized or exaggerated, as it depends upon the claims paying ability of the issuing insurance company. There must be no representation or implication that a guarantee applies to the investment return or principal value of the separate account. So can you choose a combination product where there's some in a fixed product and some in a variable? Sure, you could. So the fixed would have a minimum guaranteed interest rate, but the variable, there can never be any guarantee as to how much a client will earn. Similarly, it must not be represented or implied that an insurance company's financial ratings apply to the separate account. So when an insurance company is rated, it has to do with the safety of their fixed products. By definition, variable products are not safe. Discussions regarding insurance and investment features of variable life insurance. Communications on behalf of single premium variable life insurance may emphasize the investment features of the product provided. An adequate explanation of the life insurance feature is given. It is a life insurance policy after all. Sales material for other types of variable life insurance must provide a balanced discussion of these features. So single premium variable life, all paid all at once in the beginning, no more premiums paid. Adequate explanation of the life insurance feature. Hypothetical illustrations of rates of return in variable life insurance sales literature and personalized illustrations. So there is this idea that we are allowed to use hypothetical illustrations. Hypothetical illustrations are allowed if there's going to be some rules. This chapter is all rules. I'm sorry, I wish it wasn't so many details. It's just the way the test is. It's what happens when you become a principal. You have to be detail-oriented. I'm sorry. So the test loves this idea. Hypothetical illustrations using assumed rates of return may be used to demonstrate the way a variable life insurance policy operates. The illustrations show how the performance of the underlying investment accounts could affect the policy cash value and death benefit. These illustrations may not be used to predict or project investment results, as so doing is strictly prohibited. The methodology and format of hypothetical illustrations must be modeled after the required illustrations in the prospectus. An illustration may use any combination of assumed investment returns, up to and including a gross rate of 12%, which is really high, so long as one of the returns illustrated is a 0% gross rate. So we can do a hypothetical illustration showing up to a 12% gross annual return, so long as a 0% rate of return is also used. I would absolutely know those. That is amazing to me. Nobody asks me if I think that that should be allowed when they write these rules, but that is pretty good. Although the maximum assumed rate of 12% may be acceptable, members are urged to assure that the maximum rate illustrated is reasonable considering market conditions and the available investment options. So maybe today it wouldn't be reasonable, but you still need to know it can be as high as 12% so long as we use the zero rate. The purpose of the required 0% rate of return is to demonstrate how a lack of growth in the underlying investment accounts may affect policy values and to reinforce the hypothetical nature of the illustration. The illustrations must reflect the maximum guaranteed mortality and expense charges associated with the policy for each assumed rate of return. So it's always the ability of the insurance company to charge up to a maximum mortality and expense charge. Sometimes they're not currently doing that, but the hypothetical illustration must show what's the worst situation that they could charge, the highest that they could charge. If their current charges are less, current charges may be illustrated in addition to the maximum charges as well. Preceding any illustration, there must be a prominent explanation that the purpose of the illustration is to show how the performance of the underlying investment accounts could affect the policy cash value and death benefit. The explanation must also state this illustration is hypothetical and may not be used. So we have to say that. People think when they read something that we can use it to predict or project the future, but we cannot. In sales literature, which provides hypothetical illustrations, member firms may provide a personalized illustration which reflects factors relating to the individual customer's circumstances. So that would be perfectly fine. A personalized illustration may not, however, contain a rate of return greater than, what do you think? Not greater than 12%. So this is the highest we can ever do, but we always have to include a 0% rate as well. In general, it is inappropriate to compare a variable life insurance policy with another product based upon hypothetical performance, as this type of presentation goes beyond the singular purpose of illustrating how the performance of the underlying investment account could affect the policy cash value and death benefit. It is permissible, however, to use a hypothetical illustration in order to compare a variable life insurance policy to a term policy, with the difference in cost being invested in a side product. So that's really common, that you will show someone what it would look like if they were to put the money into the variable product, what it would look like if they bought term insurance and invested the difference. That's allowed. The sole purpose of this type of illustration would be to demonstrate the concept of tax-deferred growth as a result of investing in the variable product. So you could do that. That would be okay. Under FINRA Rule 2210, disclosure of fees, expenses, and standardized performance. So I would definitely expect this will show up on your test. Retail communications and correspondence that present the performance of a non-money market mutual fund must disclose the fund's maximum sales charge and operating expense ratio as set forth in the fund's current prospectus fee table. So if it's not a money market fund that the communication is related to, retail communication or correspondence, it must include the maximum sales charge and the maximum operating expense ratio. Testimonials are allowed under FINRA Rule 2210 if the rules are followed. If any testimonial used in a retail communication or correspondence with the public concerns a technical aspect of investing, the person making the testimonial must have the knowledge and experience to form a valid opinion. So you can't just use anybody for your testimonial if it has to do with the technical aspects of investing. Any retail communication or correspondence that includes a testimonial concerning investment advice or investment performance of a firm or its products must prominently disclose the fact that the testimonial may not be representative of the experience of other customers. The testimonial is no guarantee of future performance or success. If payment of more than $100 is made, the testimonial must disclose that it is a paid testimonial. So if the person that says something great about the fund got paid more than $100, then it's considered to be a paid testimonial, and that must be disclosed. So testimonials are allowed if the rules are followed. I don't think you'd want a professor of, let's say, sculpting to make a testimonial for your firm regarding the technical aspects of investing. That would probably not be allowable under FINRA rules. Maybe a finance professor, that would be okay. Recommendations. FINRA Rule 2210 requires communications that include a recommendation to include the disclosure of specified conflicts of interest. So anytime a recommendation is made, conflicts of interest are allowed if disclosed. Things like if the firm was making a market in the recommended securities or the underlying security if the recommended security is an option or security future, or that the member or associated person will sell to or buy from customers on a principal basis. So if they're making a recommendation in a security that they make a market in, that must be disclosed. They also must disclose if the firm was manager or co-manager of a public offering of any securities of the issuer whose securities are recommended in the past 12 months. So that also must be disclosed. These disclosures would also include if the firm or any associated person directly and materially involved in the preparation of the content has any financial interest in any of the securities of the issuer whose securities are being recommended, and the nature of the financial interest unless the extent of the financial interest is nominal. So this idea, if they're making a recommendation in which they are also a principal shareholder, is a conflict of interest. It's allowed if disclosed. Firms must always have a reasonable basis for making any recommendation. Firms are required to provide or offer to furnish upon request available investment information supporting a recommendation, and if the recommendation is for an equity security, to provide the price at the time the recommendation was made. Retail communications are prohibited from referring to past specific recommendations of the firm that were or would have been profitable, unless they follow very specific rules. So you can't just look at the past recommendations and highlight the good ones that the firm made. FINRA Rule 2210 allows a retail communication or correspondence to set or offer to furnish a list of all recommendations as to the same type, kind, grade, or classification of security made by the firm within the immediately preceding period of not less than 1 year. So this idea, if they want to use past recommendations, they have to give a list of all recommendations made in the past year. The list must provide certain information regarding each recommended security and include a prescribed cautionary legend warning investors not to assume that future recommendations will be profitable. So you can use the past if you disclose all of the past year, basically, which I can't imagine any member firm would ever want to do. Limitations on use of FINRA's name or any other corporate name owned by FINRA. Member firms may indicate FINRA membership in one or more of the following ways. In any communication that complies with the applicable standards of this Rule 2210 and neither states nor implies that FINRA or any other corporate name or facility owned by FINRA or any other regulatory organization endorses, indemnifies, or guarantees the member's business practices, selling methods, the class or type of securities offered, or any specific security, and provided further that any reference to the department's review of the communication is limited to either reviewed by FINRA, that would be okay, or FINRA reviewed. You can't say approved by FINRA, never. So reviewed by FINRA in reference to an ad or retail communication, or FINRA reviewed is okay. In a confirmation statement for an over-the-counter transaction, you can state, in quotes, this transaction has been executed in conformity with the FINRA Uniform Practice Code. That would be okay. You could say that specific quote on a confirmation for an over-the-counter transaction. They can reference their FINRA membership on the firm's website, provided that the member provides a hyperlink to FINRA's internet homepage, which is www.finra.org, in close proximity to the member's indication of FINRA membership. A member is not required to provide more than one such hyperlink on its website. If the member's website contains more than one indication of FINRA membership, the member may elect to provide any one hyperlink in close proximity to any reference reasonably designed to draw the public's attention to FINRA membership. This provision shall also apply to an internet website relating to the member's investment banking or securities business, maintained by or on behalf of any associated person with a member. Use of the FINRA logo is never allowed by anyone but FINRA. So they love that. Use of the FINRA logo is never allowed by anyone but FINRA. Public appearances must meet the general fair and balanced standards of FINRA Rule 2210. If an associated person recommends a security in a public appearance, the associated person must have a reasonable basis for the recommendation. We've said that time and time again. The associated person must disclose, as applicable, that the associated person has a financial interest in any of the securities of the issuer whose securities are being recommended, and the nature of the financial interest, unless the extent of the financial interest is nominal. Any other actual material conflict of interest of the associated person or firm of which the associated person knows or has reason to know at the time of the public appearance. So if they're going to recommend a security, they must follow the same rules in a public appearance as they follow in any recommendation that they make. Firms must establish written procedures and policies to supervise public appearances. Scripts, slides, handouts, and other written, including electronic materials used in connection with public appearances are considered communications under a FINRA Rule 2210.